Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to balance sheet concepts, balance sheet categorizations, and classifications related to current and non-current classifications. Get ready because it's time to take a stance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to, but if you have access to it and would like to, we are in the 223 Balance Sheet Current Non-Current Classification section in the Practice Problems tab. Closing this back up, we're going to have our information up top, and we're going to use that information for our classifications down below. Like with the income statement, we're going to be going through components of the balance sheet, working on concepts of the balance sheet, and then components of the balance sheet until we create an entire balance sheet so that we can get a good understanding. Like the income statement, when you first look at a balance sheet, it can be quite intimidating because it can be quite long, a lot of numbers. But if you break it down into its components and understand its parts, it's not too bad. So we're going to build up on those parts. Remember that we are in the finance. If we compare finance to basically accounting concepts, if we were to do this from an accounting practice, if you were taking an accounting class at the same point in time, you're going to be dealing with the financial statements, balance sheet, income statement, statement of cash flows, but we're going to focus in on balance sheet and the income statement because those generally include, most of the accounts in the trial balance. They include all the accounts in the trial balance that are in use, and therefore those are kind of our two main statements that we want to first focus in on. The statement of cash flow will then kind of be an adjustment. We'll take those numbers and adjust them to go from an accrual basis to a cash flow basis. So we'll talk more about that later. But when you think about the financials, balance sheet, income statement. So we're going to be using those financial statements both in financial accounting and in finance, of course. From a financial accounting standpoint, we're going to be building those financial statements from scratch, meaning we're going to have the building blocks of debits and credits. We're going to use the accounting equation as well, debits and credits, and the accounting equation. Two ways to think of the double entry accounting system. We'd go transaction by transaction as we build up the trial balance and then make the general ledger to the trial balance to the financial statements. When we think about finance, we're not typically going to go back to the transactions as much. We're not going to be drilling down on transaction by transaction. We do need to still know the double entry accounting concept, however, and so we might look at some transactions and we'll have to kind of get a feel for that, and we'll be dealing with the double entry accounting concepts, not with debits and credits as we would be doing with financial accounting, but with the accounting equations, assets equal liabilities plus equity. So therefore, instead of us going all the way back to us just building up the financial statements transaction by transaction, we're going to be basically thinking about the financial statements and the format of the financial statement, working practice problems so we get an understanding of the end result of the financial statements and how they were put together enough so that we can then do financial statement analysis, understand what they mean. Our real goal here in finance is to understand what they mean so that we can then make decisions based on that information. In the accounting courses, our goal is to actually create them from scratch, from the ground up, using transactions. Okay, so what we're going to do is go through our classification process here, and we're gonna think about the balance sheet and some classifications within it. So when you're thinking about the balance sheet, remember the balance sheet is as of a point in time, as opposed to the income statement, which is going to be a time frame, a beginning and an end. So when we think about the balance sheet, we're thinking about where do we stand as of now. Income statement, how was the performance last period? Because if you're thinking about as an investor or as a manager or someone that's dealing with the company, there's two things we want to know so that we can make decisions about future activity. One, past performance. How did they do in the past? Because they take that and predict how they did in the future. Two, where do they stand right now? How is their standing right now? Are they strong right now? You can compare this to like a runner or an athlete. If you were to try to predict the performance of an athlete in the future, you'd want to know two things, right? You'd want to know how did they do in their last few races and maybe project that out in the future as to how they could be doing in the future. And you'd want to know how do they, and that would be like the income statement. That would be like the timing statement, performance statement. And you would want to know how are they doing right now? Are they healthy? If they have the flu right now, then they may not be running quite as fast, even if their past performance was quite good. Therefore, I want to know where they stand right now. Balance sheet, income statement, same thing. Income statement, performance statement. How did they do over time? How much revenue did they make over time? How much like revenue would be how many miles they ran over a time frame, right? How much earnings did they have over the last year or over the last month? Can I project that they will do the same thing in the future? Balance sheet is going to say, how do they stand? Are they strong right now? Meaning, do they have enough assets, current assets, to pay off their current liabilities and so on and so forth? Do they have enough in terms of their needs to meet their current needs and obligations so that that won't restrain them from having a similar performance in the future, or possibly free them up to have a better performance in the future? So we're thinking about the balance sheet here. When you think about the balance sheet, you're actually thinking about the accounting equation, the whole double entry accounting system, that being assets equal liabilities plus equity. So the balance sheet is assets, liabilities, and equity. Assets, what they own; liabilities, things that they owe; and then equity basically represents the book value of the organization. You can represent this two different ways. Typically, accountants always see this as assets equal liabilities plus equity. Why? Because the assets represent what the company has, what they have claim to, or what they have, what the company owns. And then the liabilities and equity represent who has claim to what the company has. So they're two sides of the same coin. Meaning if you have total assets here, the liabilities represent third-party claims to those assets. Equity represents the owner's claims to those assets. Now, if you talk to a lot of finance people, they'll actually see this accounting equation a different way. They'll typically see it in terms of assets minus liabilities equals equity, which is just another, formulation of the accounting equation. You're just doing the algebra. Assets minus liabilities equals equity. The reason they like to look at it this way from a finance, we like to look at it this way from finance perspective, is because that means that the equity is kind of like the book value of the company. It makes sense if you're judging the company or valuing the company to think of it in terms of, well, what's the bottom line, kind of where do they stand at this point in time? Well, this is what they have in assets minus the liabilities is the equity, basically the net assets, the net value. Where do they stand at this point in time in terms of net value? The equity represents the value to the owners then. So once you then have the equity, then you got to think about, well, how is that equity then distributed, or between whoever owns the company? And there could be different type of ownerships, right? We're focusing in on a corporation, but it could be a partnership or a sole proprietorship, same concept in total. But if it was a sole proprietorship owning the company, then equity would all go to that one person, that sole proprietor. Partnership, then you'd have to think about, okay, what about that equity? How does that break out between the partners? Which could be quite flexible. You can have a 50-50 partnership, or you can have something, a 60-40 or something like 70-30 breakout, the way the profit sharing is working. So it doesn't necessarily have to be even. In a corporation, C corporation, where we have common stock, then we break out the equity more or less in a very even component, because we break it out per share. We break it out into standard units, kind of like dollars. We break it out into standard dollars. Then we got to think about those standard units as they're owned by the owner of the corporation, which are the stockholders who have hold of those standard units. So when we start to think about how to put together then the balance sheet, you want to think about the three categories: assets, liabilities, and equity. These are not accounts, these are categories. And then subcategories within those three categories, which for assets will include current assets and non-current assets. Or we're going to think about current assets here, and then other items other than non-current assets, which could include like property, plant, and equipment. So for now, we want to think about those things that are current, because they're probably going to be more current components, more current type of accounts than anything else. And then everything else we'll put into non-current. Liabilities, same thing. We'll have current. Everything else we're going to put into non-current for now. And then on the equity, we don't really have that current, non-current component. So that's what we're going to start to think about now. And then we'll have the actual accounts that will go into these categories, and that will be the actual account. So your goal then is to be able to think about this two ways. One, do you have the account? If I think about the account, where does it lie? Does it lie under assets, liability, or equity? If it lies under assets, is it a current or non-current? If it lies under liabilities, is it current or non-current? You want to think about it the other way as well. You want to think about assets and then be able to name off the accounts that are normally current assets, and normally those accounts which are non-current assets. So that's going to be what we'll start to work with here. we're going to be having our accounts kind of randomly given down below, and we want to be able to assign them out and say whether they're going to be falling into assets, liabilities, or equity, and then more precisely, where do they lie within assets and liabilities, and we're just going to name them off as current or non-current. Okay, and so we got the retained earnings. So we're starting off with the retained earnings. These are actual accounts. These are all classes up here. So these are not actual accounts up here. These are classifications that the accounts would then fall under. Where does retained earnings fall? Is it an asset, liability, or equity? The retained earnings represents earnings that have been retained. They're kind of connected to the income statement because they represent the earnings that have happened and accumulated over the life of the organization. That's how kind of the balance sheet here is related to the income statement. You might say, how is the balance sheet related to the income statement, right? Because the income statement is showing us how we got to the balance sheet point, meaning the income statement is going to show us the activity that got us here, at least the last years of activity or last month. And it's going to basically close out then to the equity section, and it closes out to retained earnings. Retained earnings represents what has accumulated upwards but has not yet been distributed to the owners in the form of distribution. So it's an equity section. Equity doesn't have current or non-current. So we're just going to say non-current. In other words, if it's not current in this classification process, we're just going to call it non-current. So we're trying to find those items that are current versus non-current. Accounts payable, where does it lie? Is it an asset, liability, or equity? Accounts payable, anytime you see payable, you're generally going to think liability. It's going to be some kind of liability. Payable is an indication in accounting terms that we're going to owe something in the future, therefore liability. Accounts payable typically represents current liability. What does it mean to be a current liability? It means that it's going to be due within a year. When you think about the liability side, it's an arbitrary cutoff. It's just like what's going to be due within a year. If it's due within a year, it's going to be current. It's important to be able to break out those things that are due within a year because we want to make sure that we have enough assets in terms of cash to pay off the current liabilities. Otherwise, we have a problem. So we're often going to see comparisons with ratio analysis between current liabilities and current assets, and even more liquid assets compared to current liabilities, because we want to make sure they can pay off their obligations in the future. Then we've got the prepaid expenses. Now you see expenses here, you might say, well, that's on the income statement. But no, it says expenses with another S. So it's not just an expense, it's prepaid. And anytime you see prepaid, you're thinking assets. Why? Because what that indicates is that we, the company, prepaid for something, paid for something, but didn't get the benefit now, are expecting the benefit in the future. Therefore, it's an asset. Why? Because we're gonna get a benefit in the future. That's what an asset is. So it's going to be something that we're going to consume in the future in order to help us to generate revenue. Most common prepaid expense will be prepaid insurance. So that means that whenever you buy insurance, you pay for it before you get any benefit. The coverage has not happened when we buy it. Therefore, we put it on the books as an asset, and then we expense it as the coverage passes, expensing it as time goes. So the prepaid expense is usually going to be current. And on the asset side, you can think about the general rule similar, like it's going to be due within a year. But on the asset side, you want to think about those items that are going to be more liquid. They're going to be things we're going to consume fairly quickly. We're going to use them in order to generate revenue, consume them pretty soon, like the insurance going to be consumed within a year, or items that are closer to cash, more liquid. Liquid means that you can spend it readily on other things. So we're thinking about current assets because we want to compare them to current liabilities. These are things that we're going to consume soon, or they can be converted to cash and therefore used to pay off the current liabilities that are going to be used. Long-term things are things like property, plant, and equipment, like the purchase of a building per se. You can't really use the building to pay off current liabilities unless you sell the building or get a loan against it. Therefore, it's not really that liquid, right? Because it's going to be a long-term thing. They're nice to have, you want them, but they're not going to be liquid in that they can be used to pay off current obligations very soon. So that's going to be the prepaid expenses. We're going to say current there. Then we got the plant and equipment. So is plant and equipment asset, liability, or equity? That's actually going to be an asset. When we buy the plant and equipment, this is going to be an item that we buy something that's long-term. So if we buy a building or equipment that we're going to use for many years into the future, even if paid cash, we don't expense it at the point in time that we purchase it, but rather put it on the books as an asset. So we're going to put it on the books as an asset. Then we're going to depreciate it, allocating that asset over the useful life of the company, of the depreciable asset, the building of the equipment. And so therefore, it's not a current item, and we're going to depreciate it, with depreciation expense and accumulated depreciation. So it's not going to be current because you can't sell the building to pay off current obligations, liabilities. The building is what it is. You're going to use it. You've invested in it. You expect the building to be there. You're not using the building to pay off debt. You're using the building to generate revenue so that the revenue will pay off the debt, hopefully. So that's going to be non-current. So then we have the inventory. What is inventory? Is it an asset, liability, or equity? Inventory is typically going to be an asset. It's going to be an asset, right? And inventory represents things. Why is it inventory? Because we bought something and we're going to resell it. So inventory could be different things for different companies. In other words, a car could be property, plant, and equipment for one company because they use it in the business. Or if they're a car dealership, could be inventory because they have it so that they can buy it and resell it. Inventory is another item that when we buy it, we don't expense it, even if paid cash at the point in time we buy the inventory. We put it on the books as an asset, and then we consume the inventory or use it, decreasing it, and expense it in the form of cost of goods sold at the point in time that we actually sell the inventory. So it's hopefully is going to be sold fairly soon. Therefore, it's going to be a current item because we're hoping the inventory is going to be selling within our normal operation. So hopefully it's going to be sold soon, therefore current item. Then we have the common stock. So what is the common stock? Assets, liability, equity. So common stock is going to represent something in the equity section. You remember that the stockholders are going to be the owners. So the owners are basically going to be in the equity section, anything related to the owners. The stocks represent ownership. So when you think about stocks of the organization, what we're doing is we're taking the value of the company. You can think of the value of the company and we're slicing it up into even components, very even things like dollars, right? We have standard units of measure, standard units of value, standard units of valuation of the company that we can then distribute out and trade easily because all the standard value units are the same. And that's going to be what the stock is. So the stock represents people purchasing these standard units of value of the company. That means if they purchased it from the company, meaning the company issued the stock to somebody, the owner then paid for it, paid the company. The payments that are going into the company will go into then equity representing that investment from the owner. So it's going to be in the equity section. Now we're going to break that out and contrast that. So we've seen retained earnings in the equity section and common stock in the equity section. Retained earnings represents earnings that have been accumulated that haven't been paid out to the owner in the equity section. And then common stock representing at least part of the investment that the owner put in to the company. Money went into the company for the purchase of the stock. Also note that the common stock, when you think about common stock, you might think of it trading a lot. Like if you think about markets, exchange markets, realize that most of the trades that go on are not going to be common stock being issued by the company. If it was an issuance by the company, that happens. But most of the trades that go on like an exchange are going to be people trading one to another, right? So once somebody purchases the common stock from the initial offering of the company, then they can take that common stock and sell it whenever they want to. And that's the point, to have the common stock having these standard amounts, these fixed amounts that are all the same, because that makes it easy for them to be traded because everybody understands the value of those stocks, at least in relation to the other stocks, because they're all the same. As opposed to if you were trying to trade a partnership interest where you have a certain percent interest compared to someone else who has a different percent interest, and your obligations and the things, your benefits and whatnot are all different. It's more difficult to trade them because you have to communicate all that information and understand it. The stocks are going to all be standard, so you can trade them off. But most of the stocks trades that you see are not the initial offering, and therefore no new money's going into the corporation. With the stock trades, they're going to be trading amongst themselves. The initial offering represents the increase in the equity. So that's going to be the common stock. It's going to be, we're going to say non-current because there's not really a current and non-current in the equity section. Then we have the bonds payable. Bonds payable, is it an asset, liability, or equity? We're going to say that's going to be a liability. And it says payable. Anytime you see payable, you're thinking liability. It's going to be a liability. Now, the bonds payable represents bonds that we issued. We needed money, so we could do a couple different things to get money, right? We could try to issue more stock to get money, to get capital, but then we're issuing ownership interest, or we could try to get a loan from the bank, and so then we'd have a payable, a note payable, or we can issue bonds, and similar kind of thing, but we would issue bonds and then have a payable that we would have to basically pay off the bonds. So you hear payable, paying off the bonds. Now, bonds could be short-term or long-term. Remember, the arbitrary cutoff for liabilities is that they're going to be due within a year. So it really depends. The bonds, when are they going to mature? Are they maturing soon, or are they going to be maturing after a year's time period? So I would assume that it would be non-current unless they were told otherwise. So it's going to be non-current here. Notice that bonds is a little bit different than some of the loans you might be dealing with, because oftentimes when we think of a loan, we think of something like a mortgage or a car payment, where we're going to be paying off both the part of the principal and the interest as we go, right? And in that case, you're going to say, well, what do I do in that case? Is it current or non-current? Because I'm paying off as we go, but I'm going to be paying off for like 5 years. Well, that means that a part of it's going to be current and part of it's going to be non-current, and we'll have to actually figure that out when we present the financial statements. We'll have to actually take those loans and break them out. The bonds are going to be a little bit different in that loans could be this way too. You could set up the loan in that you only pay off the interest, and then you pay off, and then the principal gets paid off at the end. That's the typical format of a bond. You could do that with a loan as well. But that means that the entire principal amount isn't due till after a year possibly, and the whole amount would then be non-current in that case. Then we've got the accrued wages payable. Once again, we hear that term payable. Anytime we hear payable, when we're thinking does it go in assets, liability, or equity, we would say that's going to be a liability typically because it is a payable. So it's going to be part of the liabilities section. Wages payable typically represent an accrual entry we had to put into place because people worked and yet we haven't yet paid them. So if the cutoff happened, the end of the year was 12/31, and the payroll happened to be on January 3rd, but like 5 days of the payroll period happened before the before the cutoff date on January 31st, then people had worked, but they had not yet gotten paid. And we should represent the fact that we owe them money for work they already did. So that means we're going to record a liability at that point in time for what we owe them. It's going to be current because it's going to be something that's going to be due within a year. We're going to pay them in the next payroll that rolls around. So that'll be a current liability. Accounts receivable. Accounts receivable, is it an asset, liability, or equity? Anytime we hear the word receivable, we're thinking asset. We're thinking someone owes the company money. And so the accounts receivable is the most common receivable, representing typically a sale that we made, like an invoice that we sent out for work that we did, or inventory that we shipped or something like that. And the client then owes us money. The customer owes us money because we completed the work. We completed our side of the job. They owe us the money. We expect them to pay us usually within 30 to 60 days. That's the standard terms of an invoice. And therefore, it would be fairly liquid. It would be a current asset. It's usually number 2 on the assets, right? It'd be a cash and then accounts receivable. So we're going to say that's going to be current. Then we got the capital in excess of par. Where does that go? Capital in excess of par. Is it an asset, liability, or equity? Now, this is a kind of a strange account. You can also call it additional paid-in capital. Remember when we talked about it's going to be part of the equity section, we talked about the common stock being the amount of the investment going into the company, and retained earnings being the earnings that have accumulated but have not yet been paid. The additional paid-in capital, or the capital in excess of par, is going to be kind of linked to the common stock. So the whole discussion on the common stock applies for the most part to the capital in excess of par or additional paid-in capital, because what we often do is we issue the common stock for whatever we can get, right? We, if the company needs capital, they're saying, hey, we're gonna look at the market and see what we can issue our common stock for, issue more stock, receive money for in exchange for the equity investment in the company. So we're going to try to get whatever we can, but we often assign a standard, a par rate for the common stock, which would be lower than the market rate, like $5 or something, or $2 or $1 or something for the common stock, because that allows us to see a standardization within the common stock to see how many stocks have been issued at a particular amount, a par value. However, when we issue them, we're not going to limit ourselves to the par value. We're going to issue it for more than the par value. And the difference between the par value and the amount that we issue it for will be going into the capital in excess of par or additional paid in capital. So these two accounts are basically linked. Remember, when we issue stock, we could issue stock at different times for whatever we can get, right? Whatever the market rate is, we will issue the stock for. So that means, the rate, how much people pay for the stocks will vary if we issue at different times. But the par rate will always remain the same because we set the par rate at a particular rate. Therefore, the relationship between the par rate and the amount per common stock and the amount that's going to be reported in common stock will be consistent. And the difference then is just going to be put into the additional paid in capital. So these two represent equity accounts that represent the equity investment from owners into the company, as opposed to the retained earnings also being in the equity section, representing the accumulation of revenue that has happened over time, of which has not yet been paid back out in the form of dividend distributions. So in other words, it's going to be non-current because it's in the equity section. And then we have preferred stock. Now, preferred stock, where's that going to be? Assets, liability, or equity? You hear stocks again, so you're going to think equity. So we're going to think this is equity. Preferred stocks and common stocks gets kind of confusing because not all companies will have preferred stock. When they do, it kind of muddies the water. And when you hear preferred stock, you're thinking, well, this must be, the common stock plus something, right? Because it's preferred. Must have all the characteristics of the common stock plus something else. But that's not the case. It actually doesn't have all the characteristics of the common stocks, including the key characteristic, which would make something be the common stock, and that's going to be the voting rights. When you give someone common stock, when you issue the common stock and try to generate capital into the organization, what you're doing is you're giving up voting rights as well, so that those people that have those common stocks now can basically vote for the board of directors. They're part of that process to vote for the board of directors that would then be able to hire management and be able to make decisions. The preferred stock doesn't typically have that ability. So then why would it be preferred? It's preferred because they typically get paid first. So what we've agreed to do for the preferred stock is say, hey, look, we're gonna provide a standard amount of dividends or whatever, or whenever we decide to give a dividend, we're going to pay the preferred dividends, our obligation to the preferred stockholders first. So they have a preference in terms of the dividends that any distribution that we make, we've made a commitment to basically make the distribution to them first before the distribution goes to the common stockholders. So they get paid first. So that's why they're going to be preferred, but they only get paid up to what they've been promised to get paid. And then the rest goes to the current, the stockholders, and they don't have the voting interest. But anyways, it's going to be in the equity section, and therefore it's going to be non-current. And then we have marketable securities. Now, when you hear marketable securities, you might be starting to think, well, thinking about our common stock as a marketable security of the corporation on the exchange. But that's not really what we're thinking about here. We're thinking about us as the company investing in marketable securities of another company. In other words, we have excess cash, and therefore we want to put it somewhere. And notice, if you have excess cash in the company, that you might think, well, what should we do with that? Well, if you're not going to use it, like some companies that are well established, they're not growing anymore. They're not, they're established. They're set in. They're just moving forward. They may not need the excess cash, and in that case, they should be giving it back to the owner in terms of a distribution. But if you have growth plans in the company, especially small companies that are planning growth projects in one area or another, then you're gonna want if you have excess cash, meaning earnings have happened, retained earnings have gone up, they're in retained earnings, right? You've retained the earnings, and you have cash. Then if there's a plan to use it in the future, then you might want to hold on to that cash, but you might want to then put it somewhere other than cash in order to try to get a short-term return on investment before you put that cash into whatever investment you want to put it in to achieve the goal of the organization, which is revenue generation. So that means that you might buy stocks and bonds, and so those could be current or non-current, but typically they're going to be current in that case because you're kind of putting your cash into a placeholder until you're going to use it. And also note, you might be thinking, well, what if the company is in the business of investing? Like if they're an investment company, well, that's different. If the company is designed for investments, meaning they're an investment company that collects money and then invests and generates their revenue typically from returns on investment, that's going to be a different situation. But if they're a company that does something else, we're a restaurant or something like that, then we're not in business. Our company is not designed for investments, an investment company. Then we might still put our money into some investments as a short-term holding spot, and therefore it would be an asset, and we would typically call it a current asset.